How is everyone doing? Welcome back to another episode of The Banker Next Door. I'm your host, Dr. Joe Berquist. Today, I have a great interview lined up with us. Today, I have Mac Thompson, who is the founder and president of a great company called White Clay, which does a lot of consulting with banks. And I think you're going to find they do some really cool and fascinating things. So with that said, I'm going to bring Mac in to join us. How are you doing today, sir?
Doing wonderful, Dr. Joe.
Thank you. And well, hey, it's a pleasure having you on here. And thank you again for spending some time with us today. And I think we're going to get into some really cool stuff here. So I'll kick it off by basically saying, so can you tell us a little bit about White Clay? What is the company and what do you guys do?
So we're predominantly a software company. We do advisory and we help our clients use our software to take care of the shareholders, take care of the clients. What White Clay does is it helps banks build deeper, more profitable relationships. So we're really focused on relationship banking. We're about how do you build the appropriate depth of relationship with each customer, and how do you make sure that your shareholders are getting value from that.
Fantastic. And so let me ask you this. Could you give us a couple of examples? I know you guys have some software packages and things that you work on for clients and that you guys are mainly working with banks and credit unions around the country. Could you maybe just give us a couple of examples of how you guys have used your software to maybe help banks or credit unions, either with a product or maybe in a business unit to just maximize profitability?
Yeah, I'll give you. So we have our software environment takes all the information in a bank, puts it all together, adds a bunch of intelligence to it, and makes it really easy for bankers to understand their book of business and take care of the customers. So one of the things that we did, and we're doing that, is we actually help them build their full customer relationship. So here's the relationship. Here's all the tax entities that are part of that. Here's how it all rolls up. And then you can see all the products and services they use. So for one of our clients, we found out after we put everything together, we took a look at what the portfolio looked like, that about 40% of their clients' relationships, they had the primary operating account, but it meant like 60% of the relationships didn't. So first, they didn't know that. They thought it was much higher than that. Most big banks think that there's somewhere between 70, 80% of their, especially in the community bank space. This was a larger community bank, but have a good relationship. They're the primary bank for their client and that kind of thing. Turns out this bank, it was much lower than they thought, around 40%. And over about 2 years, we helped them grow that number to about 60. They drove a tremendous amount of non-interest-bearing deposits for them, which really helped drive profitability for the banks. We moved the cost of deposits down significantly. Also improved the retention rate because you're keeping clients, because once you get their operating accounts, it's a lot stickier. But it also, just on a human level, built a lot deeper kind of relationship with their community, and so they were able to have a deeper relationship with their client, and hopefully a longer one. So it was great.
Mac, let me ask you this, and I hope I'm phrasing this correctly. So, given the example that you just gave, would it be fair to say that most banks and credit unions out there are missing out? I'll maybe say it that way. They're missing out on big, perhaps chunks of the relationship or big cross-sell opportunities because they're not fully looking and analyzing this data that they have, and they're not, really understanding what that customer relationship is. If I'm saying that correctly, if you're following along that.
You are. It is a lot of the core systems for community credit unions, community banks, even small regional banks. They really do a pretty good job of building up everything that's in the core that is attached to a tax ID, usually called a CIF. Mm-hmm. Sometimes they add in householding, which takes the consumer part of the relationship and aggregates it based upon a mailing address and things like that. Generally speaking, most banks are not very good at taking the consumer part of the relationship, all the disassociated parts of the business relationship, and non-core elements like wealth, mortgage, credit card that aren't part of the core system, and putting it all together. So it's pretty much a universal challenge. Some people do it, they're kind of rare, but most banks are challenged by how do I look at that overall aggregate relationship. And in the first part about really executing relationship banking well is understanding that relationship. And I think putting it together is definitely a challenge for most banks and credit unions.
I would agree with that. And just for our audience, okay, in case anybody doesn't understand what we mean by core systems, we're talking about Fiserv, Jack Henry, FIS, some of the main key players out there in that space that provide. And the core system is the main system that really drives everything the bank does. And the bank has many other ancillary systems that can either coordinate with the core or work adjacent to the core, but everything basically runs around that core system. So that's what we're talking about when we're talking about this kind of stuff. Let me play devil's advocate for a second, Mac. Say I'm a Jack Henry customer and I have a system like Profit Stars that is going along with Jack Henry, and I'm using that. And Profit Stars is great at helping me look at what are my top 20 customers, right? Like here's like my most top 20 profitable customers. If somebody were saying to you like, oh, hey, don't worry, Mac, we've got it covered. We've got Profit Stars. Do you get that kind of argument, or like for people and are you basically saying like, that's nice, but what I've got is taking it a step further, or is maybe doing other things that systems like Profit Stars wouldn't encapsulate or wouldn't capture?
Yeah, I first would start that Profit Star is a great product from Jack Henry. If you have it and aren't using, I would use it. But if you really want to understand the relationship, there's a lot of the relationship that's not in your core. In this case, Jack Henry. It's in your wealth platform. It's in your credit card, your mortgage, your systems that are not necessarily part of the core. So Profit Star is probably not going to pick those up. And so you're missing those elements of the relationship. The other piece is if you have a business and personal relationship, it's probably not going to aggregate those together because it won't know that Dr. Joe is part of this other business entity sitting over here. Just won't know how to put that together. So I think it's a good start. I think that the way we look at it's a lot more holistic way of looking at the relationship. And then we'll also bring in things like transaction behavior, how they're using your products. There's a lot of behavioral aspects of that customer relationship that can get added to that. I would also say like in our world, we also do profitability around all of that. And we're using some pretty advanced methodologies for funds transfer pricing, capital, expense allocation. It's almost all, we configure it directly to each individual bank. So it's a much more configured to your bank situation. And it's a more holistic way of looking at it. So, Profit Stars is a good place to start. If you want to go a little further, I think we could offer some good solutions for that.
Nice, interesting. Let me ask you this: do you think fintechs, like, are fintechs ahead of banks in this regard? Like, as far as how they're approaching this same kind of topic, like, are they doing better than banks right now in this realm?
The fintechs have a tendency to. I'm going to generalize it first. General fintechs. Uh, Generally, fintechs to focus on particularly their product. So they're very monoline in thinking about it. So they're not necessarily thinking relationships in that sense. They're thinking about how do I sell my product to this bank customer or non-bank customer. And that's really kind of how they think about it. It's not so much relationship banking. It's a product-centric kind of way of thinking about it. Now, there's some fintechs that are into new levels of new cores, next generation cores, if you want to call it that. Some of those are a bit more advanced in how they think about it, but they haven't evolved yet to where they can do it. So I think the fintechs aren't necessarily much better at this for viable reasons, right? If all you do is this particular product, you're not as interested in the rest of it. So I don't know if fintechs have an advantage in that. They have an advantage. I think their access and use of data is higher, but I don't know if they have the scope of insight around that total relationship that a bank would think about, or credit union would think about with their members. So
Okay, interesting. All right, let me switch gears here for a second. So, the White Clay can basically help their clients to utilize existing data to build stronger relationships with customers, a kind of a vein that we've been talking about here for the last few minutes. Anything else in that realm before we move on to the next thing? Anything else in there that maybe you'd want to add, or another
we do.
example? Okay.
So part of it, actually building deeper, more profitable relationships, is we'll look at profitability tools, so relationship profitability, product profitability. We'll look at incentive related to that. How do you incent your bankers? In general, incentives been moving from production, like paying for production, to paying for balance growth, to more towards paying for profitability. So we'll support a lot of folks in that transition, and we do that. But it's also more of a cultural shift. It's moving banks and credit unions from a managing more by intuition to more of a managing by fact kind of environment. And that's that cultural shift. We're very helpful in how you do that in a real way. And this entire environment that we're talking about is one that we partner with the banks. We actually help curate and run the environment for them. So we don't just show up, turn the software on. We're going to see you in 2.5 years for the renewal, right? It's something that we talk and we go through and we partner with them through the journey every single week. So thanks for asking the question.
Yeah, no, absolutely. Okay, so now I want to move on to maybe talking a little bit about strategic planning. Now, I know your company does a lot of work with helping banks and credit unions with balance sheet management. Could you just talk for a couple minutes about what you guys do in terms of balance sheet management and how that can tie directly into a bank's strategic planning?
Yeah. So while the banks usually have the treasurer of the bank probably does an ALM process either through a partner themselves using software or something. So let's say ALM, the asset liability management process, which is how they look at balancing interest rate risks and mixes of portfolios to try to get to the direction the bank wants. In our profitability process, as we're going through that, you can see all of that, how it rolls through and impacts the profitability at a client level and product level and organization level. And once you start seeing how that kind of looks, the question becomes is what do we want this portfolio to look like 2-3 years from now? You can go longer, but 2 or 3 years is practical. And so what kind of mix of non-interest bearing deposits do I want? What kind of mix of C&I lending versus CRE lending on the commercial side, business banking, consumer mortgages, and such? So you basically start figuring out from a interest rate risk, interest rate collateralization, product mix, just what is it I want my bank to look like a couple years from now. And once you know what that is, we can actually help set up how you measure all of that, and also how you incent the right behaviors from your bankers to get the results that you want on an everyday basis. It's eventually going to get you from where you are to where you want to go in that strategic plan in terms of that target balance sheet.
Very. I mean, I love this stuff. I could talk about this stuff all day long. This is great. This is great stuff. Let me ask you this. So, one of the big issues in the banking industry over the last, year and a half or so, 2 years, has been this idea of unrealized losses in banks' bond portfolios. And banks have used a few strategies to try to deal with this. Some of them have done sale leaseback on their branches to try to get money. Other banks have sold business units, mainly insurance units, which have garnered a very large premium. And then also some banks have raised capital to basically offset, whatever loss or whatever hit they may take. But have you had banks come to you and basically say, "Hey, listen, we've got these potentially unrealized losses on our bond portfolio. We're thinking about doing a repositioning of our investments to basically put ourselves in a better position going forward." But what does that look like if we do this or we do that? What are the net effects of that? And then, what are the pros and cons? Do you guys get that kind of scenario from some of your customers, and do you have to help them figure that out?
We are very familiar with the topic. I've been around it. It is not necessarily while we would probably help on the client, like the customer side of that piece of the balance sheet. I think that really gets into, it's not really what we help banks with. I think it's a great question. It's a great question for the board and for the management team. And it's about de-risking your book, your balance sheet, essentially. And you got to figure out what's right for your board and your bank. Some people are not that far out. They've got 2 more years to go. And that might be than if you've got 8 more years to go, right? So it really kind of depends on the situation of the bank. There are a lot of investment bankers more that can actually help in some ALM management companies that can kind of give you the pros and cons of your bank's particular situation. But I think it's interesting. It's a very interesting thing at this time for boards and bank management teams to be talking about. I know people are doing it, and when they do it, they felt it was right for their bank, and that's what they should do. I do think though you got to think about what's that time horizon, because it's a pretty good size hit. And what kind of things are the decisions you're making now to reduce risk? or are they really just to get an issue off the table? And you got to figure out what the right balance is for your bank. But it's a pretty big topic for a lot of folks right now,
Oh,
especially
it
ones that
is.
went long.
And absolutely. And then you also have this other issue of the repricing on subprime or not or sub debt, basically
Yeah.
sub debt that banks have issued. A lot of banks issued sub debt back in 2000 and now it's 5 years later and that sub debt's coming due and it's repricing. And then, so it's like, well, do you roll it over? Do you pay some of it off and maybe roll a little bit over, or do you just pay it off altogether? Do you have to raise other capital to pay it off?
Yeah.
Like, so there's a lot of interesting questions around that too that can lead to a lot of balance sheet management questions in the senior committees as they're trying to deal with a lot of this stuff and figure out a lot of these things that go in there. But yeah, no doubt. I mean, strategic planning is as you know is very tough today, given just all of the factors, all the different things going on at the moment, which there are a ton.
There are, and it's a very stressful time to be a bank board, particularly. I mean, it just seems like never-ending stream of issues keep coming up. But something like the issue you just talked about, it gets into why you need to come up with what you want your balance sheet to look like. Or do you have sub debt because you're finding you need liquidity and capital to fund a bunch of incremental, marginal price loans that you may or may not want to keep originating? So you've got to think about what all this stuff means, because there's folks that are tight on liquidity, but they've got some loans coming up for renewal that they may not want to renew, or let another bank have the privilege of servicing those loans, right? Or serving those loans. But that's the anti of what we experienced for about 15 years in banking. For 15 years we were just, let's add loans, keep growing loans, add some fees, declare victory, right?
Yep.
And the world changed in 23, probably changed a little bit before that, but it came to realization in 23 that both sides of the balance sheet are important. And we need to make sure that we are managing our balance. What part of our role as bankers is to actively be managing our balance sheet in a way that generates the most return for shareholders, on a risk and capital, risk adjusted basis. So I think that target, going back to your original part, to kind of circle that, is, and that sub debt, you need to make sure that you have a use for those, because if you're using a lot of that, it could be wholesale funding if it's a liquidity issue, it could be a capital raise if you need a capital. But what are you using? Who's using liquidity and funds? And are you getting paid for it? And I think you'll find a lot of the use of your liquidity and funds, you might not be making as much on that as you think.
Yep. No, it's excellent point. Excellent point, Mac. And okay, well now if I can, let me switch gears for just a second. Can we talk about you for just a minute and maybe give us a little bit of your background and why you decided to start, this company about 20 years ago?
Yeah. So I never planned on getting into banking. That was not my, I don't know if I had a plan. I was an accounting and English person, so coming out of college, and I happened to come out in a recession, early '90s recession. So I needed a job. My current wife was in college still at the time. We were dating then, and my parents were in Florida. So I went to school up in Lexington, Kentucky, at a place called Transylvania University's liberal arts school, and my parents gave me a couple weeks to find a job. It gave me actually a couple months to find a job, but it was a recession. It wasn't fun. And the first job that I actually got was a job in accounting, entering GL tickets at a bank. It was at Bank One Lexington. Right after Bank One Lexington was acquired by, I can't remember the original bank, but a bank was in Lexington was acquired by Bank One in the early '90s. So I didn't plan on getting into banking. I wasn't a particularly good accountant, by the way. And how I got into a lot of the things I did was I was given the opportunity by our good friend Charlie Christie to find opportunities to justify why I should have a job. And so I went around and I did creative stuff. And my first thing I did, what I found, was printing, paper print. And so mainframe print, we were doing about, I can't remember, 10 million pages a year or something like that at this little bank. And I cut out about 6 million of those pages, and they cost a few cents each. And it was enough that they let me keep my job, and they let me go find the next project I got to work on. So over my career in finance, I was at Bank One for a while. I did a .com, then I was at Bank of America for a while. I was a problem solver. Got put into a lot of situations that required a little bit of out of the box thinking and creativity. Had a lot of wonderful people I learned a tremendous amount from. And through that career, we built a lot of software, did a lot of really cool things. And one of the things that hit me is I was leaving Bank of America. Bank of America was a wonderful place, wonderful people, loved working there. But I was ready to do something a little bit different. I'd worked at large banks for a while, and I was in my mid 30s. And I wanted to bring the kind of information and insights that we had at Bank of America. I did consumer analytics there. I did a bunch of strategic planning, payment, just all kinds of stuff. But how do you bring those kind of tools that would help regional and community banks be able to compete? Because what we had at Bank of America was so much far in advance to what was available to those regional community banks. So when we went and started building, when we started White Clay, that's what we started off to do. Didn't have exactly the full plan to do it. Kind of jumped into it with a friend of ours that asked if we can come help them, and we did. But glad we did. So I'm coming up on 20 years next May, uh, and we've had a good journey. It's been fun, and we're helping smallest banks about 350 million. Our largest is about 200 billion. So we still work with some big banks, but uh, we get that broad spectrum of people get to help. So it's wonderful.
No, and I love to ask that question, Mac, just because I think you do have a really cool story, and I think it really is an interesting story. And for maybe people who don't know, so Bank One, that is a lot of people may not know this. That's where Jamie Dimon came from. Jamie Dimon, it was Bank One, and then it was the acquisition by Chase of basically J.P. Morgan of Bank One. That's what brought him there to JP Morgan Chase, and then obviously set him off on his journey of rising to be the CEO of JP Morgan. So that's, Mac played a small role in that whole saga and that whole thing. So, so it's very interesting. And then I would be remiss if I didn't give a quick shout out to the man, the myth, the legend that is Charlie Crist, our good friend. So hopefully Charlie's watching this and he'll get a good chuckle out of that. I am going to get you on here one day, Charlie, just so, if you're watching this, you're getting on here one day. But but I thank you so much for giving us some of your background there, Mac. And I would just like to say, I saw that White Clay was recently voted number 3 in American Banker's Best Places to Work in FinTech for 2025. And I thought maybe that's got to make you feel good, right? So I figured, maybe you might want to give a shout out on that real quick.
Actually, it does. It's wonderful. We've got a great team of White Clay. We do provide a pretty awesome environment for them, but it's an environment we all share. Um, One of the things when we left the bank was we wanted to be sure, even though we weren't Bank of America size, that we provided the benefits, the amenities, the kind of environment that you would want to work in that would make it a great place to work. And I think we've been able to do that. I think we created an environment with a great team that we really enjoy it. I appreciate the recognition for it. I think a lot of it goes to the team. I'll take my small part in that, but it is exciting. I like it. We were number 10 a couple years ago, so number 3 is better.
That's good. That's good. Hopefully, maybe one day you guys get to number 1. So that'd be pretty cool.
Inter-5's a bit tough. Those guys are competitive.
Nice. All right. Well, I'll kind of, as we come to the end here, I'm going to ask the question that I ask of anyone that comes on to do an interview with me. And that is, do you have a favorite business related movie or a business book?
I do. And it's kind of an odd one, but because it's on the entrepreneurial side, but I'll share it. I was guy named Guy Kawasaki. He used to work at Apple. I don't know if you've ever read any of his books. He's a great kind of entrepreneur, great thinker of what he thinks. He's got a book called Reality Check. It's kind of a summary of some of his other books, but it's got little chapters on sections. And if you're ever going to start a company or want to think about what that might mean, he's got sections like what are the top 10 lies VC firms tell entrepreneurs? And the next section is what are the top 10 lies entrepreneurs tell VCs? But he's got all kinds from presentations to things. There's just a lot of really practical things in there. It's not a book probably most people in banking would read, but I'd recommend it. I mean, it's like, I'll give you an example, font size. So font size on a presentation, you take the oldest person in the room, divide it by 2, and that's the smallest font size you're supposed to use in a presentation. And so it's kind of funny, but it's little insights like that. It's kind of practical. He's kind of whimsical, but it's good. It's an interesting combination of entrepreneurial, some marketing stuff, some other things. But anyway, it's called Reality Check. Guy Kawasaki.
No, and I think Guy is most famous for I think he wrote the book, The Art of the Start. I think that is I think that's his most famous book. But yeah, which is actually a great book. I've actually given that to, a number of clients over the years that have come into me and basically said like, hey, I'm thinking about starting a company. And I said, well, hey, this might be a good book for you. Then you might want to check this out. And before you come back to the bank looking for the loan, you might want to go through this book and just make sure you've kind of checked all the boxes and gotten all these other things in order first. So no, thank you for the recommendation, Mac. I think that's a great book, and I'm sure some of the audience members, I'll tell you what, this audience is fantastic with reading the books. I read a lot of books. I recommend a lot of books, and they definitely come back to me with a lot of good book recommendations. So it is a reading audience. That is for sure.
Excellent.
So, all right. Well, I will wrap up by basically saying, if anybody wants to follow you, or if or if they want to get in contact with you, what would be the best way for them to do that?
Following's probably LinkedIn. I do post, and luckily we have a great partnership with our PR firm, William Mills. But we do a lot of posts. I do a lot of publication of thought pieces, podcasts, that kind of thing. But LinkedIn, it's Mac Thompson at White Clay. It's pretty easy to find me. I don't know the exact LinkedIn address. Really shouldn't I? But if you ever want to email me I'll just email is mac at whiteclay.com. I love banking. This banking's been great to me. I want to help make sure that all the banks in America succeed. So I love it. That's why we teach at Stonier, right, man?
That's right. That is why we teach us, and that is just FYI for people. That's how Mac and I met. Mac is a great teacher at Stonier and does class with Charlie Crist, and and they both do an awesome job, and people love them. And so keep on doing what you do, man.
Awesome. Thank you, Dr. Joe. I'm gonna give you a hard time about
that. Thank you, Mac. Thank you so much.
All right. See you.
All right, everyone. Well, that was Mac Thompson, founder and current president of White Clay. And we thank him so much for coming on and joining us today. If you want to check it out, there will be a link to the White Clay website down in the description below. So feel free to check on that and go check out the website and see all the wonderful products that White Clay offers to their customers. And with that, I will wrap up by saying, if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I love getting back to everybody. And as always, make sure to check out some of the other content on the channel. I hope everyone has a wonderful day out there, and I will see you again real soon. Thanks a lot.